Chinese tea house, Chagee, has burst onto the scene and given investors exposure to a fast-growing company operating in one of the fastest-growing economies in the world. But is it even the best Chinese tea or coffee company? Let's find out! Welcome to the Food Fund. First, a little background on Chagee. Chagee was founded in 2017 and offers a wide range of freshly brewed tea beverages, including various tea lattes, pure teas, milk teas, and fruit teas. The company has expanded rapidly, boasting over 6,000 stores worldwide, with a pledge to providing healthy and low-calorie options. With nearly 5,000 employees, the company is headquartered in Shanghai, China. Over the last couple of quarters, investing $10,000 in Chagee would have returned just $4,673, losing to the S&P 500's $12,370. This is very bad. Gross margin is 49%, while revenue has compounded at around 273% since 2022 and has grown to $1.9 billion most recently. Sales continue to increase, though the rate of growth has slowed. When we look at cash flow, we see that operating cash flow has improved at a 386% CAGR since 2022. CapEx has worsened at a 234% CAGR. As a result, free cash flow has also improved at a 423% CAGR during this time period. However, cash flow peaked in 2024 and has been declining since. Could there be more trouble on the horizon? Weighted average shares outstanding have increased from 2022. Going from 100 million shares to 134 million shares most recently, Chagee has been diluting shareholders. Now let's view the efficiency metrics. Return on invested capital has worsened from 161% in 2024 to 96% most recently. Cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage, as well as inventory control, has increased, going from -24 days in 2023 to -18 days most recently. Both of these metrics are trending in the wrong direction, but are at excellent levels today. Now let's look at Chagee's debt. The net debt to EBITDA has decreased over time, going from 1.2 in 2022 to -3.3 most recently. Given that the company is profitable, this value means that Chagee has more cash than debt. This is a great place for the company to be. But is Chagee even the best Chinese beverage restaurant company? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. Okay, let's first go to the spreadsheet and write out some key values for Chagee. It is a restaurant company with a gross margin of 49%. The revenue per share CAGR is 251%, and the free cash flow per share CAGR is 364%. The gross margin is great, and growth has been great since inception. A return on invested capital of 96% is excellent but is falling. Next, the cash conversion cycle of -18 days is great. Concerning debt, a net debt to EBITDA of -3.3 means that Chagee is profitable and holds more cash than debt. So from a fundamental standpoint, Chagee looks really good. Now let's switch our attention over to valuation. The price-to-earnings growth, or PEG ratio, is 3.1, indicating that Chagee is overvalued compared to projected earnings growth. Chagee's fundamentals are clearly strong, but how does it compare to other tea or coffee stocks? Let's go to market share to find out. The dashboard shows Chagee, Luckin Coffee, and Mixue as fast food restaurant companies. Though they all have a smaller market share than Starbucks, they do command more global spend than Dutch Bros. We can also see from the bright green color that Chagee is growing market share faster than all of the aforementioned companies. Looking closer, Chagee has a 0.23% share of the market among public food, beverage, and restaurant stocks. Over the last 5 years, Chagee's market share has grown at a 146% CAGR. They've gone from 0.09% in 2021 to 0.23% today. Growth was rapid from 2022 to 2024, but has slowed recently. When we view their market share among the Chinese beverage restaurants, we see that Chagee holds about 28% of that market, but has actually started losing share since 2024. And when we widen the aperture to include Starbucks and Dutch Bros, we see that Chagee holds about 7% of global coffee/tea market and is expanding. Let's dive in with a comparison of the fundamentals. When looking at gross margin over the past 3 years, we see that Chagee had the best growth at a 20% CAGR. Starbucks had the worst with a 0.3% CAGR. Operating margin flipped from negative to positive for both Chagee and Dutch Bros, while Starbucks had a decline. Revenue per share growth for Chagee bested every other company, with the Chinese companies blowing away their American competition. Free cash flow per share growth was again won by Chagee, though both Luckin Coffee and Dutch Bros flipped from negative to positive. My takeaway from this data is that Chinese beverage restaurants are outgrowing their American counterparts, and I definitely want exposure to that growth. What is less clear is whether Chagee will continue to lead the Chinese cohort over the next few years, and the market is clearly discounting Chagee. Looking at the total return chart, we see that Chagee has had the worst share price performance over the past 6 months, falling 54%. It has been a tough period for many beverage restaurants. In fact, only Luckin Coffee and Starbucks have had positive returns during this period. Still, I am optimistic on the outlook for Chagee long term. Overall, I give this company a 6 out of 10 using my proprietary scoring system. I will be eagerly looking forward to their coming earnings report. Many thanks for watching. What do you think about Chagee? Share your thoughts below. It is always great to hear from you. Check out some more videos right now. And don't forget to put your money where your mouth is.